Hello learners, today I'm talking about short selling. It's it's very different and interesting term, um, and it has a very different features in trading. First one is broker will invest money for you, and second thing, you have to pay only security money. Third one is when price of the stock going up, you will make loss. Um, and when the price of the stock is going down, you will make profit. Yes, you hear right. And um, let's do this exercise. Question is, suppose that you sell short 1000 shares of Intel, currently selling for $20 per share, and give your broker $15,000 to establish your margin account. Okay, and if you are no interest on the funds in your margin account, what will be your rate of return after 1 year if your Intel stock is selling at $20, $22, $20? Okay, and assume that Intel pays no dividend. Okay, so let's start. To make this calculation, you have to make a balance sheet. It will be easy to find your profit or loss amount. Let's see, when your share price is $20 and $20, so on the asset side, on the other side, you have to write 1000 share, 1000 share, and per share price is $20. You have to write $20,000. This is the amount which broker pay for you. And margin, this is the security money, $15,000 is the security money you have to pay. On the liability side, $20,000. This $20,000 means 1000 shares and $20. Okay, because this amount pay broker is not your own money. This $20,000 is not your own money. And equity, $15,000. $15,000 on the asset side, you have $35,000. To make this $35,000, you have to put on equity side $15,000. On equity means here, equity means your profit amount. On the second example, um, let's see, when the price is going up. On the previous slide, we see price is $20. In this chart, we see 20. In this table, we see the price is $20, and what will happen? Then you have to write asset initially your broker will pay $20,000 for you. uh, uh, they invest $20,000 to buy Intel share, and they invest it for you, and you have to pay margin amount, that means security amount, $15,000. Okay, when the interesting is when the price level is up, going up from 22 to from 20 to 22, here liability amount is $22. Your liability amount is going up because because broker will money invest money to buy Intel share, and Intel price is going up. Okay, and your liability is also will going will also going increase. So to make the on asset side, total amount is $35,000. To make this side equivalent on the liability and equity side, you have to put 13,000 to make $35,000. Let's see, when the price is going up, your liability is going up and equity is going down, and the rate of return will be is $35,000. That is $35,000 your profit amount, and your invested amount, you invest only $15,000. $15,000, okay, and divided by $15,000, that is you make loss 0.133. On the other table, on the other scenario, when the price is going down, that means when the price is $18, on the asset side, it will be the same. Broker initially invest $20,000 to buy Intel share, and your security margin is $15,000. There will be no change in this part. It will always be same when price is what will be the initial amount. It is always be the same, whether price is going up or going up or down. On the liability side, there we see some changes. On the liability, $1,000, 1,000 share into $18. This is the price, $18, $18,000. Your liability is going down. Okay, your liability is going down, and equity, on this equity part, you have to pay, you have to do some calculation. That is, on asset side you have $35,000. On the liability, on equity side, to make this total amount equivalent, you have to put $17,000 to make 35,000 to make total $35,000. See, when the price is going down, your liability, your equity is going up. That means your profit is going up and liability is going down. See, rate of return is $70,000 your profit, and margin is $15,000. That means your initial investment. Let's see, your here you make profit. And another thing is, what will be the rate of return if the company pay the dividend $2 per share? That times total share is $1,000. In our example, total share is $1,000. 1,000 or 1,000. Total share is 1,000, and dividend will be the 1,000 into $2, since $2 per share. Okay, so dividend will be $2,000. Rate of return will be 17,000. 17,000. See, 17,000 equity, your profit. Initial amount minus initial amount, your initial investment $15,000 minus dividend. Why I deduct $2,000? Because you did not buy Intel share. Your broker buy Intel share. You didn't. Okay, the owner of the share is your broker. In this sense, you will deduct $2,000 because you will not get that $2,000 dividend amount. Okay, you will not get. That's why you have to deduct $2,000, then divided by $15,000, your initial amount. Okay. Next slide. If the maintenance margin is 25%, so how high can Intel's price before you get a margin call? It is a very important question, and it is very um, it's very necessary to know when I will call um, to sell my share. Okay, if you want to here the calculation is 0.25, $35,000. I get this $35,000 from total amount, from the total see, on the asset side and liability side, $35,000, and minus 1,000 share. This is the share. P means price. 1,000 share. P means price. We want to know the price. This is the calculation to know the price when I sell the uh, sell the share. So the price is $28.